The broadcast is now starting. All attendees are in listen-only mode.
Hello and welcome to Nova's presentation of Cash Balance Plans for Advisors with Ernie Galliani. Before we get started, I'd like to point out the panel on the top right-hand corner of your screen. You're going to see a drop-down section for questions and chat. This is where you will enter in any questions that you may have for Ernie throughout the presentation. He will answer as many questions as time permits. If time does run out and you still have questions, please send them to our email address, webinars@nova401k.com. Right below questions and chat, you will see the handouts drop-down. Here you will be able to download today's material. If you are with us today to earn continued education credits, please be sure to stay until the end to fill out our survey. This will allow us to track your time and participation. Certificates will be sent out within a week for those who have met the time requirements. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you for joining us today. I would now like to introduce from Nova, our team leader and actuary for the Defined Benefit Administration team, Ernie Galliani.
Well, thank you. This is Ernie Galliani, team leader at Nova, one of the actuaries on the staff. Welcome to our 2023 Cash Balance Plan webinar. If you've attended previous versions of this will be fairly similar. We typically add a handful of new slides each year, but if you're like me, refreshers on the details of a cash balance plan are always welcome. And if, today's webinar is intended to be more of a high-level view of cash balance plans and the power of the cash balance plan. We won't get into the weeds too much, but for any of you who do like to get into the weeds or like to discuss a particular situation or a concept in depth, I encourage you to reach out to your favorite Nova salesman, and he can schedule a call with me or your favorite actuary at Nova, and we'll be happy to discuss a particular client or a concept or anything with regard to cash balance plans that interest you. So normal disclaimers. The information in this presentation is general in nature and not intended to be a substitute for legal or tax advice. We always recommend that you consult a qualified professional such as an attorney or an accountant if you need legal or tax advice. But also add, we encourage new clients to bring their CPAs into the discussion before the plan's set up. And my happiest clients are those clients who will have their CPA draft a mock tax return with the numbers on our proposal to make sure the attended results are what you expect and what you had hoped for. And that way, when the actual tax return is prepared, there's no surprises. The intended audience, of course, is financial advisors, CPAs, and their clients. Really, the only prerequisite would be sort of a general knowledge of retirement plans, such as a 401k profit sharing plan. I assume most of y'all are pretty familiar with that, the plain vanilla 401k plan that matches 3% or 50 cents on a dollar up to the first 6% of salary deferral, so that the employer cost is sort of capped at 3%. Of course, lots of participants will choose not to participate in the 401k plan, so the employer cost in this real basic 401k plan is usually maybe 1 to 2% of the participant's payroll. The agenda. So today we'll start off with a little teaser that kind of gives you the power of the cash balance plan and what a cash balance plan might do in a ideal situation. Have a little introduction. We'll talk about various qualified plan types. Then we'll delve into cash balance plan specifics. We'll cover some frequently asked questions about cash balance plans. We won't be talking about Secure Act 2 law changes. There wasn't that much that affected pension plans. If you do have questions about Secure Act 2, there's some NOVA webinars out there, and again, encourage you to get with your NOVA salesman to address any of those types of questions. I guess I'll throw out one thing. So one big change next year is the new 401k plans are going to be required to automatically enroll participants. And then going forward, each year there will be an auto escalation. So if a participant starts at 3%, then the next year it'll be 4%, and the next year after that 5%. And it's going to be kind of a pain in the behinds for the plan sponsors. But we also have some advice for those sponsors to make the administration of those plans a little bit easier. So the teaser. So occasionally I'll run into somebody who might be interested in a cash balance plan. We'll get the idea. Maybe they're a professional, a doctor or an attorney. They'll say, "What do you do?" I say, "I'm an actuary. I set up qualified plans for small businesses, help to get big deductions." And they'll go, "Oh, really? A nice deduction? Like, what do you mean?" And I said, "Well, I can get you a $250,000 to $300,000 annual deduction, but you're going to have to give your employees a benefit each year, $1,000 plus 7% of compensation." So that's sort of, keep that in your back pocket whenever you have a new prospect or proposal. If they're the type of client that knows their payroll, knows their payroll. Oh, our payroll is $1 million. We got 10 employees. You say, okay, well, it's going to cost you 7% of $1 million, 70,000 plus 1,000, 10 employees. It's going to cost you $80,000, and maybe I can get you a $300,000 deduction if that trade-off's worth it to you. So here is the ideal pension plan. If you have an owner who's age 60, his compensation, and compensation is a really important concept. We'll dive into that idea of compensation, what that really means. W-2 comp is one example, but in this example, he's 60 years old. His compensation of $330,000, and what we've done is we set up a cash balance plan for this individual. The cash balance benefit is going to be $250,000 a year. The owner can defer $30,000 into the 401k plan. And then in addition to that, we get the owner an additional profit sharing contribution of $43,500. So for a total deduction of $323,000, which is a pretty big commitment, but we do have clients that have $1 million, $2 million cash flows each year, and would be happy to at least put a portion of their profits into the pension, the 401k plan. Now in this example, a perfect example, I say, you have a really young employee making $30,000, and the owner is going to have to give that employee a cash balance benefit of $500. And then in addition to that, they're going to have to give that employee a profit sharing safe harbor benefit of $2,000 for a total of $2,800. These benefits for the employees are subject to a vesting schedule. So the $500 cash balance benefit, the employee will have to be with the owner or be in the plan 3 years to be entitled to that cash balance benefit. And then the $2,000 profit sharing contribution, that's subject to a 6-year graded vesting schedule. So it takes 6 years for that employee to earn the right for that full $2,000. So if the employee leaves, say after 3 years, an employee would get the $500 cash balance benefit, and they would get 40% of the $2,800 of the profit sharing. The remaining $1,200 would forfeit back into the profit sharing plan and could be used to fund the benefit for another employee, or actually wind up in the account, in the owner's account. So who would be interested in cash balance plans? The majority of our clients are physicians, dentists, attorneys. Those sorts of businesses are typically ideal for a cash balance plan because you have older, well-paid professionals who typically have lower paid younger staff members. And so professional firms, we can often get 85 to 90 cents of 90% of every dollar contributed to the plan, to the owners of the plan, and maybe just 10 to 15% of it goes to the employees. And that only stays with the employees if they work with the plan sponsor for at least 6 years. Other examples, great examples, you have a small owner-only business over age 50. They don't have to worry about employees, and we can get them, once they're age 50, we can easily get them a $200,000 plus cash balance benefit, plus an additional 6% profit sharing, plus salary deferral. Companies transitioning from an older owner to a younger owner, sometimes it makes sense to put these plans in, and the younger owner will help fund the older owner's benefit into retirement. Maybe the business is selling for a few $1 million, and basically the first $1 million or $2 million in profit can go into a pension plan for the owner, and so the owner ends up not paying as much tax on the business sale of the business. And then we have companies looking for a defined benefit plan for their employees that they can understand. I'll get to that a little bit later. Other examples would be plan sponsors who have profit sharing plans, and they make a profit sharing contribution to the plan each year. Often for very little additional cost to the employees, they can add a cash balance plan and get a really nice big benefit for the owners. Qualified retirement plans have always allowed for tax deferrals. That's the motivation. The motivation for any business, large or small, is always the tax deduction for the employer, helps reduce the tax bill. In addition to that, income taxes on investment income is deferred until it's actually taken out of the plan. And even then, sometimes when owners retire, they usually just will roll their money into an IRA. So that further defers the tax until they reach age 72 and have to take required minimum distributions. And even then, the starting point's normally 3-4% of the balance. So it's a great way to defer taxes on income for a long, long time. In addition, when the distributions come out of the plan, they're taxed at ordinary income tax rates. And then, as I mentioned, unless they're rolled over into an IRA. And then the other thing that professionals really love is the protection from creditors. So at least some of these professionals will have $2 or $3 million in their plans, and at least that will be sheltered from any creditors that might sue them. When we set these plans up, we like to make these plans understandable, affordable, sustainable, and administratively feasible. There are times when the plan sponsor, the advisor, or the CPA will request a complicated plan provision, And we typically will discourage that. The spirit of the request is usually coming from a good spot, but a lot of times when you start making these plans really complicated, it becomes really difficult for the plan sponsor to perhaps provide the necessary detailed data, for example, to administer the plan, or they can just get really difficult to administer if they get too tricky. So we, all things being equal, we prefer to make these plans as simple as possible. So as you're aware, there's various types of plans that plan sponsors can choose from. The top of the food chain is the cash balance plan. Cash balance plans have been increasing quite a bit since the mid 2000s, and especially with the inflation last year in particular, the maximum lump sum in a cash balance plan has increased from, it used to be in the 2 millions. Now it's up to $3.4 to $3.7 million tax deferral. So that's a pretty big chunk of change. And so businesses with really large cash flow are really excited about the prospects of maybe tax deferring, in some cases close to $4 million in the pension plan. And that doesn't even include the 401k plan, the profit sharing. So nowadays it's quite easy if you set up two plans to get close to $4.5, $5 million for the owner, by the time they're say 62 to age 70. So cash balance plans, it really stems to when I graduated from college in the late 70s, there was no such thing as a cash balance plan. In fact, there was no such thing as a 401k plan back then. All there was this, what we call now a traditional defined benefit plan. And in traditional defined benefit plans, they look quite a bit like Social Security. You work for a company for 30, 40 years, you retire back in those days, and maybe you get a $1,700 a month pension for the rest of your life or something like that. And so typically in the old days, when you retired, you didn't have an option of taking a lump sum. You just got monthly income for the rest of your life. And that was a traditional defined benefit plan. But one of the major drawbacks of traditional defined benefit plans is they're really hard, they're really complicated to administer, they're expensive to administer, the liabilities and costs are pretty volatile, unpredictable. Sponsors don't understand them, employees don't understand them. You have an employee who's age 40 years old and you tell them they're going to get $4,200 a month for the rest of your life in 2053, really doesn't mean a lot to them. So people appreciate the cash balance plan quite a bit more because it looks a lot like the 401k plan. It's in a balance that they can understand. So going backwards a little bit, so the various types of plans, there's SEPs and there's simple IRAs, there's profit sharing plans. Those existed when I graduated from college. There's ESOPs, employee stock ownership plans. Of course, 401k plans, which are quite a bit similar to 403b, 457s. New comp plans, which I think probably most of y'all are aware of. That's where you get to do fancy profit sharing. You can max out the owners and hopefully not have to give too much to the employees. Then you have defined benefit plans, cash balance plans, and then my specialty, or our team's specialty, is we call it the combo plan. So that's a combination of a cash balance plan plus a 401k profit sharing plan. So we use those two plans together to maximize benefits to the owners and keep employee costs manageable. So one might ask, wow, how is it possible that you can shift so much money to a plan owner and have to give so little to the employees? And there is a catch. IRS allows plan sponsors to, in that first example we looked at, we gave $300,000 to the owner and we gave like $2,000 to the employee. Like, how is that possible? Well, it's possible because the IRS has non-discrimination regulations, and these regulations give specific guidance and instruction how to prove they're non-discriminatory, and that's Nova's strong suit. That's what plan sponsors hire us for. They hire us to do the non-discrimination testing so that if the plan sponsor should get audited by IRS, IRS will ask for reports that prove the plan's non-discriminatory. And in each year, that's what we do. One of the first things we do is we prepare a non-discrimination test, then we prepare the funding illustration. And if you ever get audited, we have these reports, and we pass them out to the plan sponsors, the advisors, the CPAs, all the plan principals, and upon audit, you just hand them the report, and there's the proof that the plan passes non-discrimination testing. Now, most of you all are probably familiar with 401k plans, and normally in a 401k plan, if a plan sponsor will set up a 401k plan with a safe harbor, then the standard non-discrimination testing that goes with 401k plans, that's top heavy and ADP testing. With 3 or 4%, those tests are usually automatically passed, and there's not much to worry about. So when a 401k plan gets audited, we say, hey, look, we gave everybody 3 or 4%. This is our proof that the plan passed non-discrimination testing. Skip over that. So now, what about profit sharing plans? Well, typically in a profit sharing plan, if you'll give your employees 5%, then normally you can give the owner the maximum profit sharing allowable, under IRS regulations. This year, it's about $63,000, and there's like a catch-up, or there's a catch-up of $7,500. So you can normally get the owner the maximum profit sharing contribution if you'll just give your employees a 5% profit sharing contribution. Now, what's the cost when you have a combined cash balance with a 401k plan? Well, that goes back to my elevator speech. The cost, ballpark cost, is typically $1,000 per participant plus about 7% of compensation. So we give the employees $1,000 in the cash balance plan, and then the 401k profit sharing plan, we give the employees about 7%. That's sort of general. With perfect demographics, though, sometimes we can get the employee costs as low as $500 and say 5% of comp. It really depends on the demographics. The ideal demographics are older sponsors, big compensation, and young employees with small compensation. Just touching on, so non-discrimination testing in a 401k plan, you probably heard of the average referral percentage test. If your plan's not a safe harbor, then basically what that means is the owners can only defer into the plan 2% more than whatever their employees put in. So if the employees put in 3%, the owners can put in 5%. If you have a group that's not participating, then that really handcuffs the owners from taking advantage of the 401k feature. So that's why we typically recommend that plan sponsors go with a safe harbor formula to allow the owners to max out their salary deferral. So here is an example of your plain vanilla 401k plan with a, say, a dollar for dollar match up to the first 3%. So in this case, the employees make $50,000. They put $1,500 into the plan because they know that will get them the maximum match. So they put 3% in the plan and they get a safe harbor match of 3%, $1,500. The owner defers $22,500 into the plan, plus gets a safe harbor or match, either way, of 3%. And that's sort of your plain vanilla 401k plan that people probably remember back from the, say, mid-90s. One of the greatest inventions since sliced bread was the new comparability plan. Once IRS passed regulations and laws to allow a profit sharing to kind of mimic what a pension plan does, plan sponsors were able to make profit sharing contributions and actually decide who gets what profit sharing. They could slice and dice profit sharing contributions by job titles, by classes, by participant name, or any criteria they want. So plan sponsors like the fact that they could choose how much everyone's getting. And there's, of course, you have to always meet the minimum, but once you've met the minimum, you know, hey, I'd like to give this participant $20,000. That's fine. Go ahead and give them one participant $20,000. Again, you're always subject to the IRS testing. Normally that minimum is 5%. For 2023, the maximum contribution in a defined contribution plan is $66,000 plus another $73,500 or plus a catch-up of $7,500. So the total is $73,500. That's what you can do in a 401k profit sharing plan in 2023. And yeah, I have an example for you here. So same example. In this example, it's the same thing. We were matching, dollar for dollar. It's safe harbor match, dollar for dollar. First 3%, employees get $1,500. But in this example, now in addition to the salary deferral, we're giving the employees a $1,000 profit sharing contribution, and we're giving the owners a profit sharing contribution of $43,500. So the owner is getting $73,000 out of $81,000. So about 90% of every dollar is going to the owner, and the owners like that. Probably the only thing they don't like about it, and maybe they wish they could even give themselves more. So nowadays we often just use that safe harbor design so that plan sponsors can easily max out their referral and not worry about any IRS non-discrimination testing. It also satisfies the top-heavy rules. Another type of safe, so there's a couple of types of safe harbors. There's a safe harbor match, and then there's this safe harbor non-elective. It's like a profit sharing contribution. And so there's safe harbor matches are fairly popular in plans that don't have a companion cash balance plan. But when we design a cash balance plan with a 401k plan, we discourage safe harbor matches because IRS does not allow the plan sponsor to take into consideration the safe harbor match when it comes to non-discrimination testing. So the safe harbor match is somewhat limited in its ability to help the plan sponsor pass testing. So when you see my group prepare a proposal for you, you'll almost never will see a safe harbor match, other than there's some situations where it makes sense, but by and large we don't use safe harbor match in combination with a cash balance plan. Moving on to traditional defined benefit plans, that's what was only available. That was the only thing available, the only game in town when I graduated from college. They do provide much higher deductions compared to new comp plans. But the drawback to defined benefit plans and cash balance plans, for that matter, is there are mandatory annual employer contributions. And the traditional defined benefit plan is pretty difficult for advisors and clients to understand. So that's why you won't see us design those very often. So what is a traditional defined benefit plan? How does it work? So in a traditional defined benefit plan, it looks and smells a lot like Social Security. It's based on average comp times years of service times some formula. So, for example, 10% times 3-year average compensation payable at age 65. So I'll give you an example here. So here's our traditional defined benefit formula. You got a guy who retires with 5 years of service at retirement. The formula is 10% per year of service. The compensation is $50,000. So this participant would retire at age 65 with $50,000 times 5 times 10% equals a $25,000 annual benefit, beginning at age 65 and payable for the rest of that participant's life. Typically, in traditional defined benefit plans, lump sums are not available. Nowadays, you typically only see traditional defined benefit plans, and maybe with unions. They're still very popular in unions. Unions are kind of paternal, and you see them quite often with city plans. And you've heard a lot about city plans being underfunded. That's because of the volatile nature of the liability. We won't get into that too much, but they're unpredictable. The liabilities, it really fluctuates with interest rates and that sort of thing. The maximum benefit in a traditional defined benefit plan is $265,000 a year, beginning at age 62, payable for the rest of someone's life. So somebody can retire at age 62 from a real generous business, Amazon, say maybe, or I don't know, or some corporate plan, and the executive retires with $265,000 a year, payable at age 62 for the rest of their lives. In a defined benefit plan, the contributions are determined by the actuary. So the actuary decides how much the plan sponsor has to contribute each year. It's not flexible. It's not discretionary. And so that's one of the drawbacks to traditional defined benefit plan. And the benefits earned on the plan are obligation of the sponsoring employer. So those benefits pretty much have to be paid no matter what. So we have a fun fact question for everyone. So who can have the largest defined benefit plan benefit? Would that be Elon Musk, Aaron Judge, the Yankees baseball player, or an owner of a small business, a doctor, for example? Who do you think could have the biggest benefit under the laws? It might surprise you to find out that the answer is it's all the same. All three can have a pension plan set up that would pay them $265,000 a year, annual annuity payable at age 62. If that annuity begins before age 62, that maximum $265,000 is reduced. I was at the poker game the other night, and they were talking about what the size of maximum, what kind of pension does an NFL athlete get? I didn't even talk about OJ for that matter. I don't know. And none of them believed me when I said, well, when a football player retires, say at age 30, all they can get is $3,000 or $4,000 a month. I'm like, no, you don't know what you're talking about. They can get more than that. Like, no, that's pretty much the maximum pension under law, under a qualified plan. You can certainly have an insurance policy that pays more, or annuity, but in a qualified plan at age 30, you're talking $3,000 or $4,000 a month. All right, so now we jump to the power of the cash balance plan. So in this example, we're showing the maximum benefit somebody can have in a cash balance plan at a given age. It also assumes the plan's been in place 10 years. The plan has to be in place for 10 years for owners to get the maximum benefit allowed under IRS law. So at age 55, that's $2.4 million. So for example, someone could, a client of yours, we could set up a plan for them at age 45, and they could put in a couple $100,000 a year for the next 10 years, get that deduction, and then at age 55, retire or terminate the plan, not retire, just terminate the plan, and then roll that $2.4 million into an IRA where it continues to earn investment income interest-free. And they wouldn't be required to actually start withdrawing from that IRA until age 72, 73, depending on, 72, 73. That $2.4 million goes as high as $3.7 million at age 68. So start with the 58-year-old, and they can roughly put in $370,000 for the next 10 years, if they have the salary to do so. You have to have compensation, W-2 compensation in particular, to be the basis for the benefit. Or if it's a partnership or a sole proprietorship, you have to have earned income, which is a little bit more complicated concept to base the benefit on. What you can't base it on is profits. Profits don't work. Profits is not compensation. IRS likes to see you pay some money, some Social Security taxes on your compensation. The way to think about it, if you're not paying Social Security taxes on it, it's not compensation. Here's some deduction examples. They all kind of vary by exact circumstance, but in this example, you can see at age 45, we can typically get you a $190,000 deduction. Minimum salary required is about $100,000. And as you get older, the maximum deduction gets a little bit higher, and the amount of salary required to get that deduction also increases. So cash balance plan, what is it? Well, cash plan, it's quite a bit like a defined benefit plan. We call it a hybrid plan because it's got some features from the traditional defined benefit plan, and it has some features like a defined contribution plan. A good way to think about it is as a guaranteed profit sharing plan. So what does that mean, guaranteed profit sharing plan? Well, in a profit sharing plan, the benefits each year are not guaranteed. It depends on the profits of the company. And the investment gains aren't guaranteed. It depends on however the stock market does or how the money is invested. Well, in a cash balance plan, both the benefit and the interest rate are typically guaranteed. There's some exceptions to the interest rate, and we'll talk a little bit about that later. But by and large, a typical cash balance plan that we would design here at NOVA, the employee benefit would be $1,000 with a guaranteed interest credit of 4%. The benefits are expressed as a hypothetical account balance with guaranteed annual allocations and guaranteed interest credits. The payout is typically a single sum, lump sum at termination of employment. Calculations are required by the actuary to ensure that the plan meets IRS minimum funding requirements. And like a defined contribution plan, assets do not typically equal liabilities. Here's another little fun fact. In a cash balance plan, I do not need to know about plan assets or how they've performed to calculate the benefit. I can tell you, when you set up a plan in year one, I can tell you what the owner's benefit, I can tell you what the employee's benefit is going to be in year 7 in advance. No mystery. We can put together a chart, and the plan sponsor will know in advance what the plan liabilities are. You can do it for 10 years out there. There'll be no surprises. So one of the reasons why sponsors like cash balance plans is because they can know in advance what they're looking at. And from year to year, there's not really a surprise on what the liabilities of the plan are. All I really need to calculate someone's benefit is a plan document and salary history. Sometimes they don't even need salary history. We can just state the benefit in the plan, just $100,000 a year. It doesn't even have to be a percentage of salary. All right, so let's see. Cash balance plans. Yeah, so hypothetical account established for each participant. Contributions and interests are credited annually to each participant's account. The hypothetical contributions are in interest are limited by the maximum lump sum, which is actually the maximum lump sum in the cash balance plan is not stated in the law anywhere. The law says the maximum annuity is $265,000, and then IRS tells us what mortality interest rate assumptions to use to convert that $265,000 to a maximum lump sum that I showed you some previous exhibits. So the maximum lump sum, that's not stated anywhere in the regulations or rules. It's a backed into number. The interest credit is written into the plan document. It is not typically an actual rate of return earned by the plan. I get questions all the time. From time to time we hear people who would like to design a plan with interest rate tied to the stock market. For reasons I won't get into today, we tend to discourage that. It can lead to undesirable results. We think we can accomplish the goals of the plan sponsor to simulate a rate of return, or maybe to get what they're looking for without going to the actual rate of return of interest. But again, I'll encourage you to get with your favorite Novus salesman if you want to talk about using actual rates of return in cash balance plan, and we can have a phone discussion about it, and maybe we can come up with something that works for you and the plan sponsor that accomplishes the goals that you're trying to meet. So here is an example of a typical plan participant statement. In this example, the account balance of the owner is $200,000. The interest credit is 5%, so 5% of $200,000 is $10,000. The contribution is $50,000, and the account balance at the end of the year is $260,000. As you might imagine, it'd be really easy just to project this out 4, 5, 6 years and know in advance what the owner's account balance will be. Cash balance formula. So in the cash balance plan, we write in the formula which describes the benefits that all the participants are going to receive. So the owners, in this example, owners might get 75% of compensation. Other highly compensated employees might get 20% of compensation, and all other employees maybe 15% of compensation. This is just an example of how someone might write a plan. Non-discrimination testing would be required. This is more typical of a formula we would write for plan sponsors, where the owner gets $150,000 a year. Highly compensated employees who are not owners, or we typically exclude them from the cash balance plan. And I'll explain that in a second. And then say the rank and file employees, non-highly compensated employees, would say get $1,000 a year. Now, IRS has a definition of highly compensated employees, and the definition is $135,000 a year. So anyone making more than that's a highly compensated employee, and anybody making less than that is not considered a highly compensated employee. And as I mentioned, we typically exclude them from the cash balance plan because in an odd twist, IRS allows us to discriminate against highly compensated employees. So you could have a highly compensated non-owner, and IRS will let the plan sponsor discriminate against them. So what we typically do is we exclude them from the cash balance plan. We put them in the profit sharing plan, We give them a 3% top-heavy benefit, which satisfies non-discrimination testing. And then if the owner has a highly compensated employee that they really like or feels like they deserve a bigger benefit, at their discretion from year to year, they can say, hey, Nova, would you please give this highly compensated employee $40,000 this year? And they give them $40,000 one year and nothing the next. It's discretionary. So we don't like to put highly compensated in the cash balance. We don't like to put that obligation on the owner, and it also works to the owner's advantage when it comes to non-discrimination testing. So here's a typical cash balance plan illustration. You got owner one, owner two. We like to give owners the same benefit if at all possible. One's 58, one's 60. We're giving the owners $250,000. It's about 75%, 76% of comp. And in this example, we're giving the staff 15% of compensation. So this is just like a plain vanilla cash balance plan without a companion 401k plan. Now, if we add it to this very same group, if we add a companion 401k plan, we can typically increase owner benefits and reduce the employee benefits. Remembering we still have to pass non-discrimination testing. So we'll jump to the next exhibit. So in this example, owners get the same $250,000 cash balance benefit. We're going to also give them a $43,000 profit sharing benefit and get their benefits up to $323,000. In this example, we're giving the employees cash balance benefits that range from $300 to $700 a person. We're giving profit sharing contributions, let's see, about 7.5%. Yeah, let's see. Yep. So we're giving 7.5% profit sharing contributions and a smaller 2% cash balance benefit. So the advantages of cash balance plans. So they're much easier to understand than a traditional defined benefit plan for both the sponsor and the participant. It's really easy for the sponsor to budget contributions. It's basically whatever they sign up for. If they sign up for, $200,000 plus $1,000 an employee, that should pretty much be the cost from year to year, without too much variance. Participants, they get a statement once a year. It shows them what was contributed on their behalf, and it's, I think people are generally pretty happy with, or can understand the cash balance pretty well. If the asset allocation is highly correlated to the interest crediting rate written into the plan document, then assets and liabilities will grow pretty close. I mean, for example, nowadays, you could write a plan and with a 4% interest credit, and you could put the money in a 4% CD, and you pretty much won't have any variance at all. Assets will always equal liabilities. Plan sponsor will always almost know to the penny what they have to contribute. It's very, very predictable, the deductions each year and what the owner benefits are going to be, what the employee benefits are. There's no surprises. I will diverge here for a second. Section 199A of the law added qualified business income for pass-through entities. It's pretty complicated. In a nutshell, what I'll say is you get a pretty big deduction by putting in a cash balance plan for pass-through entities. In certain situations, that big deduction will get even bigger. It's complicated. I would highly recommend you get the TPA involved, have them do a mock tax return, and see if that even provides even more incentive to put a cash balance plan. We have an example here, and on this example, without the cash balance plan, you have $600,000 in adjusted gross income. you've got a 401k plan, you got a $55,000 deduction. The AGI, adjusted gross income after deductions, is $545,000, and you have estimated taxes of $142,000. Now you put in a cash balance plan, and now you're putting $285,000 in both plans. You get a QBI deduction of $63,000. Your AGI after the contribution is $252,000, and your tax bill drops by about $100,000. So most sponsors like the fact they can reduce that check to Uncle Sam. In this example, the owner is an owner-only participant. Participant's tax filing status is married, filed jointly. The business is deemed to be a specified service, trade, or business. Other deductions are ignored, and the cash balance deduction is less than the maximum deductible contribution available. So, those are the assumptions in that one. Cash balance requirements. Remember, it's required annual contribution. It's not discretionary. I can't tell you how many times, it happens more than you expect. Plan sponsor has a big business year, wants to put in a cash balance plan. He says, hey, I want to put in $250,000 a year. So, all right, this is a commitment. You're going to have to put in $250,000 for the next 5 years. Are you sure you want to commit to that? Oh yeah, I'm sure I want to do that. I believe, yeah, business is looking pretty good. So, okay. So they put the plan in, they put in $250,000 in year one. And then in year two, they don't fund the plan. And then late year three, they come to us and say, I can't afford this plan anymore. I had a bad business year in 2022. I can't fund it. I'm like, wait, we're halfway through 2023, and you're telling me now you can't fund the plan. Yeah, but you told me I had discretionary. I could do what I want year to year. Oh no, we never said that. The contribution is required. So if you sign up for $200,000 a year, plan on contributing at that for the next 5 years. There are exceptions. Business tanks, you can freeze the plan, and if you get audited, IRS will likely not have an issue with it. In-service distributions are allowed at age 59 and a half, thanks to the Secure Act. It's a 3-year vesting schedule in a cash balance, so you don't get the 6-year graded schedule. Spousal requirement: the spouse must consent at the end at the very end, when the owner terminates the plan and wants to roll the money into the IRA. The spouse has to agree to that. If the spouse doesn't agree, then the owner has to buy an annuity with that money. Doesn't get to roll into an IRA. Occasionally, we find situations where the spouses don't want to sign, and advisor or wealth manager will talk the spouse off the ledge, but the spouse has to have consent. Investments are not participant directed. It's not like a 401k plan. And then we've also got this pesky government agency called the Pension Benefit Guaranty Corporation that is involved in cash balance plans if they're not owner only and if they're not professionals. So depending on the type of business, like if you're a contractor or a fast food franchise, you would have this government agency, and they charge about $100 a year per participant. The Pension Benefit Guaranty Corporation, it guarantees benefits for employees throughout the nation, and so it's a government agency, so they collect premiums to pay for pension plans that terminate underfunded. Now we'll jump into some frequently asked questions. Who would be interested in a cash balance plan? Owners where the workforce or staff is 10 years or more younger than the owner. Companies looking for big maximum deductible contributions. Companies with steady, predictable cash flow. Companies with the new comp plan who are making profit sharing contributions, because often they can add a cash balance plan and it doesn't really cost them much more employee-wise. Organizations with an existing traditional defined benefit plan, they might want to switch over to a cash balance plan. And then owners planning to sell their business in the future. There might be, with good planning, there might be a way to basically fund the retirement with the sale of the business, using that money to fund the pension plan and defer taxes. As we mentioned, why would a company with a new comp plan be interested in cash balance? Well, often companies that have a profit sharing plan or new comp plan, they typically budget 5% for that profit sharing. So sometimes for a little more, sometimes for free, or for a very little amount, they can add a cash balance plan and really have almost no additional cost to the employees and get a really big benefit for the sponsors. If you have a plan like that right now out there, let your favorite Nova salesman know, and he'll get you a proposal and see if it might be something your clients might be interested. What is the interest crediting rate? The law requires that the plan document have an interest crediting rate. It gives rules for what interest rates you can use. Sometimes I mentioned people like to use actual rates of return. You have a year like 2022 when the stock market was down 22%. It causes real havoc and problems and headaches for the plan sponsor. So last year is a good example why you typically don't want to use actual rates of return for your interest crediting rate. IRS allows a 30-year treasury rate, a 10-year bond rate, fixed rate, 3%, 4%, 5%, 6%. We typically draft our plans with 3 to 5%. Again, can you use actual rate of return? You can. You kind of discourage it. If you really have your heart set on it, schedule a call with your favorite Nova salesman, and we'll have discussion and see if we can figure out something that makes sense. Pretty complicated, usually more expensive to administer. So we'll look at it. What is considered compensation? W-2. As I mentioned earlier, you have to have compensation to base the benefit on. Without compensation, there's no benefit. Profits are not compensation. So the type of compensation the IRS will allow a pension plan to consider. W-2, of course, that's really easy. Schedule C, line 31, K1, line 14, must pay self-employment taxes, otherwise not considered compensation. No compensation, no benefit. Plan's investment allocation have to match plan interest crediting rate. No, it doesn't. It can match whatever the plan sponsor would like to do. If you outperform, deductions are in the future will be less. If you underperform, you have to make up whatever losses there are on the market. Nowadays, with a 4% CD, you could have a 4% interest rate in the plan. And in this example, we show everything is even Steven. Every year, liabilities and benefits exactly match. The contributions, like you sign up for $400,000, it runs like clockwork. Or in the same example, the plan sponsor puts in $400,000 in year 1, puts $600,000 in years 2 and 3, puts $360,000 in year 4, and then nothing in year 5, and is exactly the same spot. Ends up with $2.1 million of assets. Yeah, so you can sign up for $400,000. Typically in year 2, you can start pre-funding the plan. So whatever you sign up for, I can typically get you a deduction in the year following 25 to 50% more than you signed up for. So if you don't get what you want in year 1, hang on. By year 2, we can typically get a bigger deduction for plan sponsors, and they basically pre-fund the plan. So rather than fund it for 10 years, maybe they fund it for 5, 6, 7 years. I see we're almost out of time. Are there any questions?
Nope, there's no question. Or actually, just one just came in. Is a minimum benefit required in a CD plan?
Yeah, there's a minimum benefit for the employees. For the owner, no, but for the employees, yes. Typically $500 to $1,000. Is that the question? Minimum benefit?
Yeah.
Yeah, because there's a requirement. You have to in a cash balance plan, you have to cover at least 40% of your group, and with a minimum benefit. So depending on the age of your employees, the minimum benefit is usually $500 to $1,000.
Okay, that's the only question we have right now. If you want to go ahead and you can finish up if you want.
Okay, well, if you have any questions we didn't touch on, a specific situation, call one of your Nova sales guys and let's schedule a call. We'd love to discuss a particular situation, client with your concept. Thank you for attending. Look forward to seeing you next year.
All righty, perfect. Just a reminder to everybody to go ahead and fill out the survey at the end of this webinar. It'll pop up as soon as we close out. This is going to allow us to track whoever will be needing a certificate. If you have any questions, like Ernie said, go ahead and reach out to your favorite Nova salesperson, or you can email us at webinars@nova401k.com. To view this webinar or any that you have missed, you can see our recordings on our YouTube channel, which is Nova 401k Associates, or you can visit our website, which is www.nova401k.com/webinars. Thank you, Ernie, for your time today. And thanks again, everybody, for joining. We hope you enjoy the rest of your day. Bye.
Thank you.